What if I'm self-employed?
What is a mortgage?
What is your primary fixed rate?
How much do I need for a down payment? This video is about answering those questions. There are 3 different ways you can get a mortgage in Canada. Okay? You can get an uninsured mortgage where everything goes. You have access to the big banks, you have access to A lenders, you have access to B lenders, you have access to private lenders. Then you have 2 categories. You have an insured mortgage and then an insurable mortgage. Both of these mortgages have to be insured by CMHC, Sagan, which is formerly Genworth, or Canada Guarantee. This means they need to qualify under their particular guidelines. And each of them have different guidelines. But I'm going to simplify it and not go into the deep guidelines, but what is on the surface. So in an insured mortgage, you have to qualify on a 25-year amortization at 4.79% interest rate. You're only qualifying at the 4.79% interest, but you're actually accessing the lowest rates amongst these 3 options, okay? And under the insured program, you can put less than a 20% down payment, okay? Now, many people confuse insured with insurable. The difference between insured and insurable is that you will need to put over 20% down payment so that it qualifies under insurable. But you have to qualify under the same guidelines at the 4.79% and qualify at a 25-year amortization. But you don't pay the insurance premium. The lender actually buys these insurance premiums in bulks and offers them to their clients that are putting more than a 20% down payment. Now, the rate difference between this and this is normally about 0.05%. This is where it gets a little more confusing. With an uninsurable mortgage, anything goes. You will have access to private lenders. You will have access to B lenders, which are alternative lenders that will charge a higher interest rate, but they have more flexibility in their qualifications. Or you can do it with an A lender, where you can go up to 30-year amortization, but you are not insured with Sagan, CMHC, or Canada Guarantee. The lender is actually not insured by those companies. That means that you are paying a slightly higher interest rate by normally about 0.10% to 0.15%. Why? Because the lender has more skin in the game for uninsurable mortgages. An uninsurable mortgage can range between 30-year amortization. Some of them will go to 40-year amortization. These include conventional mortgages with A lenders or B lenders, or a combination of both, or a combination of a first and a private. So uninsurable is a huge topic on its own. If there's one thing you can take from this video, is the difference between the insured and insurable. Because if you need a 30-year amortization, you cannot do it under the insured or insurable program. You will have to go uninsured. You will still get access to great and fantastic low interest rates, but not as low as the insured and insurable market. I hope this video serves you well. This is a complicated for not just the consumer, but for everybody involved. Sometimes lenders or mortgage brokers don't even know what guidelines to send us under. But I think we have figured it out. But if you have any questions, if you don't know which one you fall into, put a note in the comments below or send me an email and I'll gladly answer those questions for you.